focus on what the problem you're solving. So think about, before thinking about the money, thinking about investors, thinking what's the product you really want to solve, and make sure there's demand there. So that's at the end of the day, we want to make sure that product is there, there's a market for it, and get that nailed down and have your data, have everything kind of researched and prepared, be prepared, and I think you'll do well from there.
Hey everyone, this is Devin Miller here with another episode of The Inventive Journey. I'm your host, Devin Miller, a serial entrepreneur that's grown several startups and 7- and 8-figure businesses, as well as the founder and CEO of Miller Akeel, where we help startups and small businesses with their patents and trademarks. If you ever need help with yours, just go to strategymeeting.com, grab some time with us to chat. Now, today we have another fun expert episode with Akeel Jabber. And just as a quick introduction to what we're going to talk about, it's one of those topics I think that all or most startups, I don't know all, but a lot of startups and small businesses get into, which is, the questions around fundraising, what to look for, what others are looking for, how to position yourself, how to set yourself up as an acquisition target, how to evaluate your company, maybe a little bit into marketing strategy for raising and or acquisitions. Maybe talk a little bit about SaaS companies and should you be one and should you shift to one, and whatever other good topics that come to mind. So with that much as an introduction, welcome on the podcast, Akeel.
Thanks for having me today, Devin. Appreciate it.
Absolutely. So now before we dive into kind of the expert topic at hand, just to introduce yourself a bit to the audience, kind of let them know why you're an expert on this episode or why they should listen to what you have to say.
Sure. Yeah. So just to give you guys a quick background, my background is actually, I was a petroleum engineer turned entrepreneur. So I actually started working in the corporate office, went through that entire journey of, how can I quit my job? And, for over 6 years, that was over 6 years ago. And here I am today, focusing on my own ventures. And just to give you maybe a little summary of how I got here in terms of on the investment side, I actually started investing in the stock market as my kind of first way of making money on the money I saved. After about 2 or 3 years of trading, I realized that a lot of different faults of focusing on stocks itself is I realized I had no control at that point. Things could change overnight, and you had no control of kind of the price. At that point, it was already public, so it was also very super competitive. And that's around the same time that I came across a book. I think you probably heard about it, by Robert Kiyosaki. The Cash Flow Quadrant, Rich Dad Poor Dad, and that's kind of where I learned the idea about building cash flow income to replace my active income, while also, how to properly leverage debt to grow. So I saved a bit of money at the time, bought some real estate in Canada, which I still own today. And at that time I'm in my early 20s, and I said, it's kind of slow for me, right? I'm making a few $100s here on my cash flow, but I'm in my 20s. I need to accelerate this. I want to move fast, right? I'm impatient here. So I started learning about, different ways of how can I, improve my investment. So it looks great, but I look at, real estate more of like a 20-year or maybe kind of investment horizon. So I thought of investing in existing businesses, and I think that at that point we built and actually opened up. We have a franchise gym in Canada, and that has similar to the SaaS business where you have that recurring membership revenue. I like physical businesses; they're great, but they're super expensive if you want to scale, and you're also location dependent, right? So this gym is in Canada. If I want to operate another one, I've got to invest $500,000, $1 million to open the next one, next one. And I look at that maybe like a 5 to 10 year investment. So it's a little bit quicker than real estate, but has higher risk, but still decent rewards. Then I learned about, online businesses. And I think that, years ago, that's where I bought my first affiliate content kind of website from a marketplace called Empire Flippers. If you guys haven't heard about it, I think that one was making something like $2,000 a month at the time. But that's where I really got to learn about how to monetize websites. That's when the basics of SEO, how to run different conversion rate optimization tests. And that's where I got hooked. So that's when I quit my job 6 years ago. I joined a firm at that time. I moved from Canada. They were doing what I really wanted to do, which was like, building a portfolio of larger businesses. So they were doing like 7-figure acquisitions. That was a company called Wired Investors. So just got to learn the ropes to join them as the CEO of $99 Social, how to manage, bigger companies. And now, 2 years ago, we found Horizon Capital, and that's where we are today, where we have, a slightly different approach of how we build our own portfolio.
Awesome. And that's, I think it's a great introduction. Gives people a chance to hear a little bit about why you know what you're talking about. So now with that, let's dive into it. Because I mean, for not all companies, some companies, fundraising is a big portion of or big effort for a lot of startups and small businesses. Then for some, it's not. some are self-funded, some have a minimal amount of investment, some you can bootstrap, some you can do others. But for a reasonable amount of startups and small businesses, if it's a one that's more cash intensive, it's going to take more to get up and running than you can self-fund or that you can do with friends and family, or any number of reasons. There are reasons why you would go out to get fundraising, and fundraising can be everything from crowdfunding, it can be friends and family rounds, it can be angel investors, it can be venture capital, it can be debt financing, or you can go out and get a loan, take a mortgage against your house. There's a lot of different ways. But if we're then focus in a little bit, and I think where you would be at was probably more on the angel investor or venture capital side. If people are looking to go that avenue as far as to do fundraising, what are some of the things that they should initially be looking at to position themselves to be successful if they're initially looking to do a raise or raise some funds for whether it's a business idea or a business that's already up and going, they're wanting to grow and expand, kind of what should they be doing to position themselves?
Sure. Yeah. So just to clarify, we don't do VC investing specifically. It's a little bit slightly different in terms of valuation. But let's just say you're looking to raise. We do growth equity. So we work with SaaS companies looking for growth equity, or they want to get acquired. So kind of a different playground.
So, let's pause right there. So for the audience that doesn't know, what is growth equity, or what's the difference between angel, growth equity, venture capital, and kind of what should they be, or what does that mean?
Okay. So let's start with growth equity. So growth equity is, let's say I'm running this business. I've been managing by myself. I've been have some money. I have some partners working on it, but I don't want to sell my company, but I want to sell a minority stake, let's say 20, 30%, somebody to come in and I sell my shares, and I'm going to continue to run it. And you're going to come in as a partner and you're going to help me accelerate it because you have expertise in what you're doing. Maybe you're better at marketing, maybe you're a better product, and you're going to bring some cash to the table, and we're going to really drive this company forward. When you talk about acquisition, so that's basically when you're selling at least 51 shares, control of the business. Sometimes, typically you might step away and you're no longer operating the business and the new person takes over. And then the last one, which is, on the VC route, is when you're looking to raise capital. You're staying as the founder. You want to sell a smaller share of your company for future potential. So you need accelerated, capital at this point, that you have a plan of how you're going to accelerate the growth for. And that's where when you're thinking about VC capital, you have to look at it that you have to be able to show hockey stick growth. So you've probably heard of that term before, where you've got to be able to show how you can take that money and really, accelerate the return on that, because the VCs are expecting super high growth if you're going to pitch that idea.
All right. No, I think that's a great explanation and helpful run through. So thank you. So now back to where you were going, which is, okay, you guys are saying, if I were to summarize it, you take 20 to 30% as the position where the company is at least established or up and going a bit. And now they're looking to either accelerate that growth a bit and, to have someone come in and take a minority stake that give them some either money so that they can, compensate themselves, or more likely money to grow the business. So they're looking to say, okay, how do we position ourselves to do that? So what's the kind of what should they be thinking about? Should they be thinking about doing in the first place? When is a good reason to think about it? When are bad reasons to think about it? And if you are a good candidate, how should you position yourself? And I know there's like 4 or 5 questions in there. So as much as you can hit on would be great.
Sure. I think you've mentioned something really important. And that's the question people are thinking: should I be raising money? But ask yourself that. This is a point. It's super important. Make sure you're only raising what you actually need. So think of, if it's your own money, right? If you have extra capital, if you have too much money in your account, what happens? You become inefficient. You decide looking for things to spend on, and you just don't manage it as well, right? So don't go say, I heard this before. We're going to go out to market and I'm going to raise anywhere between 3 million and 10 million, depends on what the market says. So what I suggest is you actually come up with real numbers first, like do an assessment of your cost for what you'll need for, say, the next 18 months. So you have an idea, right? Like, we want to build this product. This product is going to cost us, we'll need 3 engineers. We'll need a product manager. We're going to need a designer. We're going to need to do some conferences. We're going to do some marketing budget. And you have kind of a high level idea, and then maybe add like a 10 or 20% buffer from there, right? So, use real numbers. Don't go out there and, it's kind of a disrespect a little to investors too for raising too much. And you see people, right, like that, blowing it on parties, on expensive office. Don't make a difference.
So now that those are the things you should, and I agree. I think that, or one of the things you hit on was that, when you're raising money, don't just go out. It's not always good to go out and get as much money as possible or as much money as people are willing to give you, in the sense that one, you're most of the time when you give up more or when you take in more money, you're going to have to give up more equity. Two,
Right.
most of the time there's expectations that come along with the money. The more money you take, it does come with expectations that there's going to be return on that money and that's going to be used well. And so if you take $5 million when you only need three, then you either have $2 million sitting in the bank, or you have to pick, and you're either giving up more equity, you're accruing more interest, you're having more expectations. And so I like the idea of first see whether you need it and to what degree you need it. So now let's say I come up and say, okay, I'm going to make a number. I need $5 million. I took this is our needs plus 10 or 20%. And I say, okay, we're looking to expand, to grow. We're wanting to sell off a minority stake. And so they come to you. What is the way that they should be positioning themselves such that they are successful, or they're ones that you would want to invest in or otherwise partner up with?
Yeah. So I think from there, once you know kind of you have your numbers, the most important part to get the intention of an investor is getting your pitch deck right. So just like think about, applying for a job, right? That's your resume. That's your CV for investors, right? We actually have an article on your website if you want to check out, you need help with structuring that, horizoncapital.com/pitch deck. But like I said, decide why you want to raise there. You mentioned different options, right? There's revenue-based financing. You can use debt. You can just stay bootstrapped. There's nothing wrong with that. But if you insist, you have that unicorn, or you can show that growth. I think it depends the different categories in. If you're in that very early stage where you're just like starting off and say, like, I have this idea, you're selling at that point. The sale of that pitch is about you as the founder and the team, and why they should invest in you, and why you're the person that can tackle it. Okay, so let's say you're an accountant or maybe a lawyer, and you're facing this problem over and over again. You have this technical expertise in legal, and maybe you want to build a product that you've seen repeatedly with your clients, but in the legal tech field. You understand the product, you understand the field, you understand the clients, you understand the industry, the business. But a mistake, what I'll see here is, do you have the technical expertise? So maybe what I'm talking about here is like the actually developing the code. If not, then you need to figure out how you're going to hire or partner with the CTO. A mistake people make here a lot, I'll talk about, is like they'll go say, hey, I'm going to hire a team in India. I'm going to outsource the idea to them. They're going to build it for me. It just doesn't work. I've seen this many, many times. You think just spending the money and handing it over to somebody, it's going to work. You don't know how to manage the code, if the code quality is there. And in the long run, it's going to cost you a lot more, right?
No, and I agree with you on that point. It's hard. I mean, even whether it's in India, whether it's in the US, if you don't have somebody that's a tech, or for lack of a better word, technical co-founder, or a CTO, or at least someone that's high up that can manage that, you don't know if you're overpaying, if you're getting a good product, if it's good code, if it has a lot of flaws. They're taking too much time? Are they not taking enough time? Are they spending too much? And so all of those questions, if you've never been through it or don't have somebody that does or has been through it or knows what's going on, it's one where you can fail just on the merits, not because you don't work hard, not because you don't have a good idea, but because you don't have that background in order to manage that.
Exactly.
So let's say you have the technical, CTO, co-founder, you build the world's best team, or at least in your mind the world's best team, but a good team, and that that is definitely important. What are some other things that you should be in to position yourself?
Okay, so you have your CV, your pitch deck, right? You've got your product, you've got your team, you're ready to go out. You know how much you need. Now think about when you're same thing. I'll keep using this analogy of looking for a job, or maybe dating, or your partner. You're choosing your boss. Do you have a good cultural fit with the investors? Not all money is the same, so don't think you can go out and raise from any investor that's willing to invest in with you. See if you have that kind of cultural fit with them. So let's say you send it out to 50 different or 100 different investors, and you now start talking with 10 of them. It's just like you went out for 10 interviews, and now you get to decide, okay, I really like this company, I really like what they're doing, I believe in what their product, I really liked the person I spoke to, how they behave. Do you get along with them? Do you want to spend time with them? Would you go for coffee, a beer? Would you have dinner with them? Because remember, you're going to be tied to this person for the next 5 or 10 years. So I've done this before, even myself, right? Where I've raised capital from the wrong investor, and it's going to be a lot more headache than it's worth. Okay, so think about the cultural fit. Make sure you actually want to work with them. And then the second thing is, if you're thinking, okay, now let's say I narrow it down, I really like these 3 or 4. Maybe look at what is their domain expertise, right? Like, do they have connections in this field? Are they experts in this field? Have they done it before? Because they can help you with hiring in the future. They can help you with making better decisions on your product, on marketing, because you're going to have a lot of issues as as your journey, right? That's part of the game, as part of the get through that. That's something you want to look.
No, and I think that definitely is a
That makes
important.
sense.
Yep. No, I think that's definitely insightful.
Yeah.
And makes sense. So now
Yeah.
so let's say now we're going to shift gears just slightly. And so you've gone and you've raised the money you need. You've got the product. You're doing well. You've been out in the marketplace for a few years and you're saying, okay, I don't plan on being with this business for the next 30 years. I eventually want to retire, or I want to go on to the next idea, or I want to do something else. And so now I want to be acquired. So now, opposite side of getting investors to get a company up and going or to grow it. Now you're saying I want to make an exit. What do you then do to position yourself for to be an acquisition target, which is kind of the opposite side, which is also what a lot of times investors eventually are thinking of. Hey, that we're setting this up so it's a unicorn, or they'll be acquired, or there'll be merger or acquisitions, or an IPO, or some exit event. And so if you're saying, hey, I want you to set myself up for acquisition target, what should they be thinking about?
So a couple of things like I look for if I'm looking for an acquisition, one is really like growth opportunity, right? So, the problem we see with people, they come to us when their company is kind of flat, or maybe they're starting to decline, right? That's not attractive for investors. Like, yes, hey, but we're doing this and all you have to do is this and grow it. But if it was that simple, you probably would have already done it, right? Is it a growing market? So like, is the market growing in which the demand, is there demand for this? Is it going to continue to grow? Is it just a kind of a one-time fad? And, it doesn't matter how much marketing, how much we improve the product. This is just a shrinking market. So we like growing markets. And then is there quick wins that we can apply? So same thing on the growth side. So those two sides on the growing market, and then growth of the actual business. And then it's really about risk assessment for us. So we have like 100 plus point checklists. Where we create like a scorecard out of 100 of how we like this business. And we'll just kind of rank, okay, product, design, the team, the marketing, the growth. Look at all these, LTV and CAC ratios, all these kind of fancy numbers. But, really, I want to see growth in revenue. I want to see growth in users. I want to see sticky clients who love the product. So typically for us, like, we're not product people as good as we are marketing people. So we love founders, technical co-founders who come to us and say, look, I've built this great product. I've spent the last 5-7 years building it, and I've grown organically, and I've focused on building the best product ever. But I haven't spent anything on marketing. I just haven't had to. And I really don't know. That's not my expertise, and I don't enjoy it really. So they come to us, and that's where that's our partnership, our value add. We come in, we know what works for your market, for your product. And we just really kind of add fuel to that fire. And you'll see that, right? Like when sticky clients who stick, you'll see that higher LTV. So that's lifetime value, how long a client sticks around. You'll see lower churn. So churn is, how fast are your clients turning over? So are they canceling? Are they leaving you every few months? There's something wrong. They don't enjoy it. And the last thing is like growth and the management shouldn't depend on the owner. So we've seen this as well, right? Like you're the owner, you are the business. And so many of your relationships and your clients are dependent on you. That's actually a risk for us because it's tied to one person and not the business. And if we're taking over, we don't want to have that kind of risk of like, once you leave, the client's going to leave with you, or that, it was all completely based on that relationship. So we can add that. We also adding to that is like, let's say 30% of your revenue is considered a risk that comes from one client. So try to spread out how your client base looks like, that you have that kind of buffer, so that if one client leaves, you're not left with half the revenue. And we can do things in kind of the structure when we've done that before, where let's say like 40 or 50% of the revenue comes from one client, and we'll say, okay, we're going to pay an earnout on that amount. So we'll pay you 100% on this 50% of revenue, because this is spread around 50 different clients. But this one huge enterprise clients is just way too risky for us, because if they leave in the next year or two, we're going to lose all the revenue. And we will, as long as they stick around for the next year and they continue to pay and be clients, sure, we'll pay you the remainder out of the valuation we prepared. But the problem from us is like, okay, that's nice, we didn't pay for it, but what happens if they do leave, right? If the client leaves, now you're stuck with a company that's doing half the revenue. Right? It's like, yeah, even though you didn't pay for it, but you still have to, manage this thing, and you have half the revenue to manage, half the money to grow, half the money to work, manage your team. So you have to look at things like cutting costs, spending less on marketing, less on growth, and it just becomes an ugly situation for everybody.
So if I were to maybe try and attempt to summarize that, correct me where I'm wrong, there's a couple things. One is you're looking for growth. You're looking for increase in revenue. In other words, you're on an upward trajectory, upward trajectory for acquisition. And then you're also looking for diversity. They don't have, maybe one or two big clients, and that's if those one or two clients leave, or they go under, or they they go somewhere else, but that takes away from the business. So diversity, good growth, good management, and I'm sure a good product or good business are some of the things you're looking for acquisition. So now we're going to switch gears just a little bit. And one of the other things we talked about is SaaS companies. And it seems like everybody is trying to be a SaaS company in the sense that, you're wanting that recurring revenue. So for those of the audience, if you haven't caught it before, SaaS company is often software as a service, which basically means rather than paying, if you're to think back 20 years, you would buy software, you buy it out, you go in, you buy the box, you get it on the CD or the jump drive or whatever, you load it on your computer, and that's it. You use it for the next, or however many long, unless you need to upgrade, then you don't need to. Now everybody's wanting to be a service company where you pay that monthly reoccurring revenue, where it's a steady income stream, where you're not always having the pressures of upgrading, or you're having a foundational base of customers. And so a lot of companies are now saying SaaS is the model, because now we can have that recurring revenue, and it's easier to grow and to scale and to reinvest and everything else. So question on that is, when should you be a SaaS company? When shouldn't you be a SaaS company? When should you be thinking about shifting or pivoting to a SaaS company? Kind of how would you tackle that for different businesses?
Sure. Yeah, maybe I'll just add one point to the last one, just to give you a quick scenario. So VC versus how we do it. Two things you mentioned was growth and revenue. Like we like companies kind of flat, doing 10 or 15% year over year growth. Like we're happy with 10, 20, 30%. VCs are expecting 100, 200% year over year, 10, 15% month over month. So growth is going to be a completely different ballgame, and you're going to get a lot more money and valuation based on that. Second thing is going to be your cash flow. We're looking for break even or positive cash flow versus a VC. They're happy with, companies burning 20, 30, 50, 100 grand a month, as long as they're growing the top line and, looking at the future. So just something to look at as well, and think about how you position your company. In terms of switching and kind of how to get started to SaaS. So I actually see this many people switching over to SaaS who've built, I'll say, maybe in your field, fantastic service-based business. And nothing against, I actually absolutely love service-based business because they're high cash flow, they're easier to start. But the one thing they'll find after years of kind of grinding, clients leave, they come back, different products, they ask for different things evolve, but it's harder to scale and manage. You always need more people. Every time you need to grow, you need to add more people. Things move, and on and off, and your costs are kind of managing that. Is kind of becomes a pain, and people just get kind of burnt down to that model. And obviously, there's a little bit less margins because you have people to kind of look after that. And like I said, if you're thinking about that, like moving to SaaS, think about what you're an expert already. Look at what you're already working on to solve, and the problems that are coming up repeatedly in your day to day. And then start thinking, right? Like if I want to build a SaaS, like start asking your clients that, right? Like ask your client, what is a problem you're looking to solve? Or is this a problem that you're seeing repeatedly? And would they be willing to pay for a solution here? I think that's kind of a simpler way to get into it. So that's one way you can go and start interviewing people around you in your industry and start building a solution for them. The other way you can do is actually go out and work for a SaaS startup. So go find a startup that you really enjoy, maybe want to get in that world, learn, whatever you're good at. If you're in product, if you're in sales, if you're in marketing, doesn't matter. Get your foot in the door, learn the environment, learn how it's done, what it takes to kind of build a SaaS and be in that part of that growth. Or the third option is actually, kind of do what we're doing, is buying an existing established SaaS startup. So there's a lot of companies, even micro SaaSes out there that, pretty small companies. So instead of saying, yeah, I'm going to go spend 100 grand and build this product that, some of my customers said they might like and they'll pay, and I'm going to lose money for a couple of years, but hopefully, grow in the future. There's companies out there who've already built something, maybe have some product market fit, or they've actually built the code there. And they have some revenue, they have some clients, but they just want to sell. And you can kind of come in at a little bit later stage than where they have already built to.
No, I think that definitely all makes sense. Now, one follow-up question. We are reaching towards the end of the podcast, but I'd love to hear your thoughts on it. There's some of the companies out there that maybe aren't necessarily traditionally SaaS companies, whether it's a plumber, whether it's a landscaper, whether it's, other blue collar jobs, or whether it's, even a law firm. Most law firms are reoccurring. They have clients that maybe bring work back, but it's not a reoccurring revenue where it's, hey, every month you're going to pay me so much. And there's a little bit of shift to it, but whatever the industry is, there's a lot of ones that are traditionally not there. Should you be, should you be looking, if you're in those industries, as a way to set yourself up as a SaaS? Just as a matter of course, should it be, as you mentioned, only if it makes sense, or kind of if you're saying, hey, I'd love to have that recurring revenue, I'd love to set myself up to have that customer base, to have that diversity, set myself up for acquisition? Should you be, is it fitting a square peg in a round hole? Or are there opportunities that people should be looking at to shake up traditional industries that haven't done that, to begin to kind of have that first mover advantage?
100%. And I think we're seeing that more and more happening with different service business. So that's called, I think we call that productized services. I've managed, that was a company I managed before called $99 Social. So that was the kind of whole business model is, you pay $99 a month and you get, social media posts 7 days a week for your business. And I love them. The thing is with that over code. So with code, you have to write code. You sell the product and the code does all the back work for you, right? It's running overnight 24/7 to give you what, the service or product. With productized service, you really have to have really, really good systems and processes, and you have to be really defined. So I think, be defined in your product and, one thing that you're doing really, really well repeatedly, and that somebody's willing to pay as recurring value. So people think I want to build recurring revenue, which is nice, but which is actually a lot better. So even from an investment perspective, we love recurring revenue. We don't like, one-time annual payments. Those are nice too, but those are, you don't have that recurring cash flow that you can predict of what's going to look like and how things are going to change with the business. So I think it is actually a good middle ground. If you're, service business and you don't want to shift directly to SaaS and build a product, I think the productized service is happening. You see that in cleaning, you see that in, those different blue collar businesses. And I would highly recommend everybody to try that for sure.
No, and I'd agree. And I think that, oftentimes, and I'll take to that just because I'm in the legal industry, you get in certain industries and people say, oh, well, it's always been done that way. Yeah, everybody else can do it that way, but we can't do it because we're a different type of a thing. And it's interesting how often you really find that if you were to look at the industry, there's a lot of opportunities to shake it up, to do something different. And don't do it just for the sake of being different, but look and say, where is the industry headed? What can be done? How can I take advantage of that? And how can I, rather than just do it traditional way, we're doing it the traditional way because that's the best way, or just because that's always how it can be done. And I think there's a lot of industries they'll continue to shift to be SaaS products, or at least, service products where you're having that revenue, because it makes it so that it's a more sustainable business. So I think that definitely makes sense.
Especially with the older industries, right? Where like there's a way of doing things and there's an old, thinking mentality around it, like oil and gas, legal. I'm sure it's just everything is so bureaucratic. I think there's just a lot more opportunities in those spaces as well. So
I think that's definitely correct. So, well, as we wrap up, and there's always so many more things on that I would love to chat about that we never have time. So sometime we'll have to have you back on and chat some more. But at least for this episode, as we wrap up, I always like to end the episode with one question, which is, I have my different questions for the normal inventive journey episodes, with the expert episodes. Always like to, kind of focus it on what we just discussed. And so with that, if people were to say, okay, we talked about a lot of things about how to set myself up for investment, how to set myself up for acquisitions, should I be a SaaS company? A lot of great things to cover, but I can't do it all at once. And if I could only pick one thing, if there's only one thing I should get started on, if you're talking now to somebody that's in a startup or small business, maybe they're just getting started or they've been established for a bit of time, they could choose kind of one thing to get going on. What would that one thing be, or what would you recommend that one thing being?
I think it's on what the problem you're solving. So think about, before thinking about the money, thinking about investors, thinking what's the product you really want to solve, and make sure there's demand there. So that's, at the end of the day, we want to make sure that product is there's a market for it, and get that nailed down and have your data, have everything kind of researched and prepared, be prepared, and I think you'll do well from there.
All right, so if I were to summarize it, figure out what the problem you're solving is, figure out if there's demand, and then go to work.
Get to work, man. Get to work today.
All Well, I definitely appreciate you coming on the podcast. Shared a lot of great knowledge. Now, if people have additional questions, whether it's, hey, they want to reach out to you, they want to get more information, they want to pitch you an idea, they want to see if you'll invest in their company, they want to get feedback on pitch decks, they want to be an employee, they want to join your company, they want to invest in your company if they can invest. They want to be your next best friend, any or all of the above. What's the best way to reach out, contact you, or find out more?
Sure. So we also have a podcast called SaaS District. So you guys can look that up on YouTube or any of the podcast directories. Otherwise, just reach out Horizon Capital, HORIZEN capital.com. You can reach out or directly to me on Twitter or LinkedIn. You can find me at Akeel Jabbar.
Awesome. Well, I definitely encourage everybody to reach out in one or more of the ways that you just mentioned. Definitely a wealth of knowledge and a great expertise and appreciate you sharing that. Now, for all of you that are listeners, if you either have your own expertise to share or you'd like to be a guest and share your journey, feel free to go to Inventive Guests and apply to be on the podcast. Two more things as listeners. One, make sure to click subscribe in your podcast player so you know when all of our awesome episodes come out. And two, leave us a review so other people can find out about all of our awesome episodes. Last but not least, if you ever need help with patents, trademarks, or anything else, feel free to reach out to us. Just go to strategymeeting.com and are always here to help. Thank you again, Akeel, and wish the next leg of your journey even better than the last.
Thank you so much, Devin. Appreciate you having me on.
Absolutely.